I die before 75, then it's not subject to income tax and drawdown. Above that, it is. But suddenly, there's all these extra taxes that weren't going to be there before.
So what if I told you that the future of business success has been shaped by someone who's spent over 30 years helping entrepreneurs, property investors and international clients design smarter, more resilient financial strategies, navigating tax, legislation and global structures with precision? Welcome back to Brave Bold Brilliant Podcast, the place where we dive into the journeys of trailblazers, innovators and visionary leaders who are redefining success. I'm your host, Jeannette Linfoot, and if you're scaling a business, building wealth, or ready to embrace bold change, you are in the right place. Now, today's guest is Chris Wilkins, Chartered Certified Accountant and founder of Wilkins Southworth. Chris has advised a diverse range of clients, from startup founders to major landowners and international investors, guiding them through complex tax and financial landscapes for over 3 decades. You are going to love this episode. So, Chris Wilkins, here we are again. Second time,
same office.
Same office, but a lot has changed.
Yeah.
So you joined my mum. I think it's just my mum that's been on my podcast twice.
Wow, okay. Exalted company.
Exactly.
And tax.
And we're going to be talking tax. We are going to be talking tax. But before we do that, Chris, just give us a little bit of a plotted history on kind of yourself, how you ended up getting into the world of tax and being our incredible accountant. This man has saved us a lot of money, let me tell you. So, where did life start?
And then I guess life started from a tax point of view when my mum, who was a nursery school teacher, I went to see her accountant. And he had, it's sort of like a 3/4 plinth room with the old company seals in the corner, the grandfather clock. And he was like your typical accountant, if you imagine one, 3-piece suit, bowler hat, rolled umbrella. And I used to sit there at age, 9 or something. My legs were dangling from the chair, eating my biscuit, a glass of orange. And he was basically adding up my mum's accounts in his head. And I thought, wow, if you could do that and get paid for it, that's not too bad. So that's sort of how it started. And then I got a job with them.
Oh, did you? You got a job with him?
So I got a job with them, I then qualified with Robson Rhodes in City Road in London, who in those days, I suppose, about the 6th largest firm. And then when I'd qualified, I moved to Panelker Forster, which is probably the 4th largest. And I went to Guyana with Lord Beaverbrook. We bought 250 square miles of the Demerara. We bought the Demerara Sugar Company, the Demerara Sugar, the river. And then I reversed one of our clients on the Toronto Stock Exchange. So I went out to Toronto. And then since then, I ended up being the CFO of a company on the Toronto Stock Exchange. We've acted as the largest landowner in Bucharest, Romania. Acted as the largest telecommunications business in St. Petersburg, Russia, and the stories are amazing. Sort of timber mills in Lusaka, China, gold mines. It's quite an interesting story, actually, if I say so myself.
And it's interesting. Tax, accountancy, it is full of interesting people. Despite the image, actually. The image of accountancy is that it's like men in grey suits and it's quite boring, but it's not at all, is it? Clearly not.
I think it's sort of what you make of it. And it's sort of like if you're good at something, it's a bit like saying, do you like it because you're good at it, or are you good at it because you like it? And it's a bit like that. And once you do this stuff, then funnily enough, people ring you up and say, oh, I've seen you've done that, how about that? And you get more of it.
Yeah.
That's how it happens.
Well, in actual fact, we got introduced originally by our mentors, Rob Moore and Mark Homer, when we were kicking off our property business. And then all these years later, you've helped us immensely with all of our different businesses and tax positions. So from personal experience, I can 100% recommend Chris and his team at Wilkins Southworth. So if you need anything to do with tax, you got to hook up with Chris and his gang.
Okay, thank you.
No, you're welcome. It's very true.
So
and,
I think a lot of it is you sort of got to move with the times, and I always say that to people, you've got to keep on reading about tax and learning about it. And it's a bit like saying, when you go to the doctor, you don't, and if you've got a headache, you don't want the best headache tablet 5 years ago. You want the current one. So if they're not up to date with the new tablets, and we're not up to date with the new tax legislation, Companies Act legislation, then you can't give the best advice. So you've got to be. We do something called CPD, Continual Professional Development. So then you're on courses, so that then you can impart that knowledge to your clients.
Yeah, and it's constantly moving, isn't it? And we're gonna touch on, because what we wanted this episode. And check out Chris's previous interview on Brave, Bold, Brilliant, because that's again a whole different load of content and interesting things that we talked about. But for today, what I thought would be interesting and what we discussed was you've got lots of different types of people in different situations, and a lot of those people may not really understand what's available to them or where their risks may be in the context of tax. So we're going to get into a little bit of that. But at the moment, and talking about how fast things are moving, Chris, there seems to be this sort of, I wouldn't call it a mass exodus, but there does seem to be a bit of an exodus from the UK right now of sort of quite high net worth individuals that are leaving. They're leaving the UK, moving overseas, very often linked to their tax position and kind of what's going on. And I know that you've advised and helped practically a number of high profile kind of clients that are doing exactly that. So I just wanted to touch on that, your opinion on, is it a mass exodus? What's going on? What's driving it? And if anyone's listening to this, it's not just necessarily about the uber rich, but around protecting, your position, etc. So yeah, what are your thoughts? There's a lot in there, Chris, to talk about. Let's kick off. Mass exodus, brain drain from the UK. What's happening?
So, if you go back to our previous podcast, then we wouldn't have been talking about this, because basically the domicile regime is out of the window. Now, they say that the thing about Great Britain is that we gave tax advantage to people through the domicile regime. Now, the domicile regime was basically, if you think of, say, someone like Robert Maxwell. He was born in Czechoslovakia, and literally his heart or abode never resided in Great Britain, so therefore his domicile was out of the UK. His avowed intent was to be buried at the Mount of Olives in Israel, which is where he was. He lived at the largest council house in Great Britain, which is Headington Hall in Oxford, which is now part of Oxford Brookes University. But literally your heart's never been in the UK, your domicile's not in the UK, which means in those days you weren't taxed on money that you earned out of the UK, not remitted to the UK. Now, you could say, well, that's a way of appeasing the rich. But if you look at other countries, so Portugal's not got a non-habitual residence rule, which was €100,000. Now, you might say €100,000 sounds a lot of money. But they reckon that by changing the domicile rules in the UK, we're potentially losing £12.2 billion. So to give you an idea, the Livingstone brothers, which I read in the paper a couple of weeks ago, their income tax was £104 million a year. And they've now left the UK. And if you think the average salary is about £34,000 in this country, that means you've got to have 21,500 people to pay that much tax. So if the 1%, the top 1% paid the big chunk of all the UK tax, about 29% of all UK tax. So if the top 1% go, who's going to pay the tax? So you could, a lot of people going to Italy, so say Milan. Now there, it was €100,000 a year, now it's 200,000. But €200,000 is peanuts if you're paying £104 million a year in tax and income tax. So a lot of these people are the higher earners, but they're saying, look, enough's enough. And then what happens is, well, who's going to replace those people paying the tax? And that's the issue, because this country, as about 48% of the country don't pay any tax. So it's a case of the numbers just don't add up, and that's the issue. So a lot of these countries are just saying, come here, because my non-UK domicile clients would say to me, Chris, if they don't want me in the country, that's fine, but I come here, I spend my money, my kids come here, I go to theatres, I spend it in restaurants, all the rest of it. I could spend it anywhere else. I don't care. I'm peripatetic. Now, all that happens is that money's not being spent in the UK, so it doesn't help the economy.
But it's actually hurting the economy in two levels, really, isn't it? Because one, you might think, if you're listening to this and you earn an average salary in the UK, you might think, oh, bloody good, those fat cats, they should be taxed to that level. But the reality is, what you're saying is, if 48% of the population are paying zero tax, you've then got the top 1% that's paying a massive chunk of tax. That pays for social services, it pays for child benefits, it pays for the NHS, etc. So actually, by the high-end earners leaving, it potentially then has an impact on social services, on budgets and everything. So it hurts the average person as well, doesn't it? Not just the high earners.
Because the government just haven't got the money. If you think of, say, the Laffer curve, so a Laffer curve is just like an upside down teacup. And basically that's the rate upon which people will pay tax. And they say that people will put up with income tax rates of perhaps 40 or 45%. But if you go to the extreme and you tax people at 100%, no one will pay it. If you pay zero, then you'll never have enough money to pay for the expense of the country. So where on the Laffer curve, like I say, a bell-shaped graph, an upside-down teacup, however you want to do it, they'd say, look, 40 or 45% is about the most. Other than that, people will just say, look, I've just taken my laptop and I'll go to Portugal for 100,000 for 10 years. I'll go to Milan. They'll have me with open arms because they want my money. So someone's got to, Monaco, there's no tax there.
Yeah, I mean, look, Dubai again. Sort of Middle East is another area where it's.
And we've had clients, or you name them all. They're sort of the rich ones saying, "Well, thanks very much, but no thanks."
Yeah.
I'll take my laptop and go.
Absolutely, and it's a brain drain then, isn't it? And these are business owners that potentially would be creating more jobs in the UK, investing, spending, all of that. So it's an issue, isn't it? It's a problem.
But it's not just that. If they're out of the country, they're probably doing deals out of the country, and those deals may have been in the UK.
Yes.
Their kids may be out of the country. They may grow up in another country, and otherwise they may have been entrepreneurs in their own rights here.
Yeah.
Because their parents may have set them up, but that is all lost as well. So there's maybe generational problems.
No, it is. It's a fascinating area. And one of our joint friends, Matt Fidesz, who won't mind me saying, because Matt has been on my podcast, but I know he's moved to Portugal with his family and he's been quite open on social media about, kind of the impact of that, etc. So, it's people that we know as well, not just sort of, media personalities necessarily, and sort of people that have started with nothing and have built their business from scratch in lots of cases,
Yeah.
So Chris, let's thank you for covering that because it is highly topical. What's the answer? Actually, I'm sure that's a very big question.
I'd be doing what all the other countries are doing, like France and Portugal, saying, come here and spend your money here. Now, whether you call it domicile, whether you call it habitual non-residence, whether you call it the golden visa, which some do. Either way, you need people over here to cover the expenses, because other than that, the country hasn't got enough money. So to give you an idea, in the last budget, which is 30th of October 24, Rachel Reeves said, I've put aside £9 billion for a rainy day. Well, if you think our budget is about 1.23 trillion, and trillion has got 12 noughts, so 9 billion is about 0.9% of the total budget. And then you've had wars, tariffs, the domicile tax. It's just not enough. So she's going to have to come back this year in the autumn and she'll be asking for more tax, because the numbers just don't add up. She took £45 billion out predominantly in employers' national insurance in October 24, and she's going to have to do something again this year. And we're talking about billions. There's going to be a lot of bad news out there for tax.
Yeah, no, it's difficult, isn't it? But even like the NI, if you're a small business owner, I was talking to the company that's developing our new website, right? And it's a smallish business. It's got about 25 people in that business. And the owner of that business said to me, he was planning on creating 4 new jobs, 4 new roles. But because of the increase in the NI that he has to pay, he can't afford to do that. So that's 4 jobs. That's just one example. That only be 4 jobs, but multiply that as well over time. And there's a lot of businesses that would be growing and creating jobs that are not able to because of the extra costs involved in running their business as well, right?
So after that budget, PricewaterhouseCoopers, the largest firm of accountants in the country, said it's going to cost them £40 million in extra employers' NI. What they're going to do, they're going to outsource more jobs out of the UK to save money. They're going to use more AI, and they're going to make redundancy. Well, none of that helps the UK economy. But you think, well, that's the sort of normal reaction. So it's sort of like ABC of O-level economics. That's sort of what's going to happen. If you're going to tax people that much more, what are they going to do? They're going to react and save money.
Yeah.
And that's detrimental to the UK economy.
Yeah, absolutely. Absolutely. I think we should have Chris Wilkins for PM. Vote here. But no, I mean, I think it's a poison bloody chalice, that job. I tell you, it's not an easy one to fix, is it? But Chris, so you deal with lots of different size of businesses, solopreneurs, partnerships, big businesses, property, service businesses. I mean, your clientele is pretty broad ranging, isn't it?
Yeah.
So you've learnt a bit over the years.
I like to think so.
And as you were saying, you're always keeping current because you have to be, otherwise you become irrelevant, right? And your clients are looking for the expert advice from you. So I wanted to pick on a couple of different types of people, groups, and just talk around some of the risks, some of the things that they should bear in mind from a tax point of view, or things that they can put in place to kind of protect themselves. So let's talk about startup entrepreneurs first, because that's a big, we're talking about trying to drive the economy. I think something, I mean, you'll know the numbers, is it 50% of the UK economy is driven by SMEs? Is that roughly about right?
Probably even more than that, but the small businesses represent a big chunk of it, and that's what's getting the economy going, because when you start off, you then hopefully get bigger, employ staff, pay rates, VAT, all the rest of it, which helps the country.
Yeah, so the startup entrepreneur, someone that's thinking of starting a business, and if you're in this space, now you might even have a job and just wanting to start a bit of a side hustle as well to kind of get yourself going. So if you're in that space and listening, what are some of the, and I appreciate it's very complicated, but maybe 2 or 3 tips, things to consider from a tax point of view as a startup entrepreneur starting your business that they should think about and pay attention to?
Okay, so if I was going to start, say I was a self-employed electrician and I went around working on people's houses, repairing some of their electric problems, I guess the first thing I'd want to do is set my business up so I'm not VAT registered. So if I'm working for Mr. and Mrs. Joe Average, they're individuals who aren't VAT registered. Now, in this country, if your turnover from a self-employed or partnership is less than £90,000 per annum, you don't have to be VAT registered. So £90,000 is very generous. So if you think that the 3 main taxes that bring in the most money is income tax, national insurance and VAT. VAT brings in about £170 billion a year. But you don't have to be VAT registered if your turnover in a 12-month period is £90,000 or less. So compared to, say, other countries, so Spain, the first euro of income is subject to VAT. If you look at, say, Germany, Belgium, the Netherlands, Portugal, their VAT threshold is €25,000 per annum. So £90,000 is the highest in the whole of Europe. So I would then set up my business, and as a self-employed electrician, I would be 20% cheaper than my competitors because they're VAT registered, and as an individual, you can't claim the VAT back. So if my invoice was £100, my competitors would charge VAT at 20%, and they'd be £120. Because it's to a householder, they wouldn't be able to get the VAT back. So then you could start your business that way and grow it on the basis that you would be cheaper than your competitors. So a self-employed person could build up that. And then you may then, as you got bigger and became VAT registered, you may then want to consider sort of what entity you go into next. And so it could be that, say, my turnover got up to £100,000 and I could still be a self-employed. Now, if I was a self-employed electrician with little material costs, then my profits may be, say, £80,000 or £90,000. At that stage, I may consider whether I wanted to bring anyone in partnership. So as my life evolved, you may then have a partner, a spouse, and that person may work or may have lower levels of income. So in the UK, you can earn up to just over £50,000 whilst you're still a basic rate taxpayer. So if I was earning, say, £100,000, then above the 50, I'd be paying 40% tax. However, if I've got a spouse or a partner who wasn't working, had low income, I could have a partnership with that person, and then in theory, if we split the profits, we could each have £50,000. Now, the beauty about that is that this £50,000 isn't being taxed at 40%, because the first 50 you get £12,570 tax free, and then the next 37,500 is taxed at 20%. Anything above that is 40% up to 100. Now, if that was like that, then neither of us would be paying 40% tax. And coupled with that, I may be claiming higher income child benefit charge, and that gets tapered down if I earn more than £60,000. So the advantage of then is splitting it is I save tax and I can get other allowances without them being abated. So I could then split it amongst my family if that was possible. Or even if my partner earned a low salary, say £20,000, if I gave that person £30,000 of my partnership income, we'd still only have taxable profits for a maximum of £50,000 each. So by doing that, you could spread it across two of you. You could save more allowances, and then if you were worried about doing something wrong, you could have not just a partnership but a limited liability partnership, and that's where you've got the protection of the veil of incorporation. So then you can't get sued if you did something wrong. They'd sue the limited liability partnership rather than you, or you could have a limited company. So then it's a case of how you deal with those entities. And then with an individual sole trader partnership, limited liability partnership, you are taxed on your profits. If that income was in a limited company, the company's taxed on the profits, and then you've got to take the money out of the company. So you pay corporation tax and income tax. Whereas an LLP or partnership, if for the sake of argument I earn £50,000 and I need £50,000 to live on, it probably isn't worth me putting it in a company, paying corporation tax, and then take it out of the company and paying PAYE or dividend tax, because I'm getting hit for two lots of tax. And that's where it gets expensive.
Yeah, so tax, it's not just about the tax that you pay, it's also around how you structure the legal entities as well in order to optimise the tax, right?
Yeah, there's some people that sort of can't have the protection of the veil of incorporation. So if you're in some professional bodies, so then you take out professional indemnity insurance, things like that. So, but you've sort of got to work out from a tax point of view as to which entity you want, and it may be that if your business gets bigger, it's so big that you have to protect yourself, and you could do it by a limited company and a limited liability partnership. Both have protection of veil of incorporation, and then it's a case of which entity suits you best. So a limited company has shareholders. So you can have a number of different shares. A partnership, you are partners in the business now, and you've got a shareholders agreement dictates how the shares are split and allocated, and the rights of those shareholders. A partnership agreement for a limited liability partnership does the same as partners. So you have a capital sharing split, profit sharing split, etc. But you then need to decide how you want to take the money out, dividend, salary, things like that. And then you've got to bear in mind that in the budget, one of the chancellor they did was that there was what's called an employment allowance. So if you employ staff, it's got to be more than one member of staff. You could claim £5,000 as employment allowance. Now it's £10,500. So you can actually get some money back, which means that, say it's you and me in the limited company, then we need salaries in order to get the £10,500 credit back. And if it was just you and me, ideally we need salaries of about £70,000 to pay enough employers NI to get the credit of the full £10,500 rather than dividend.
Yeah.
So if we had dividend, there's no employers NI, and then you say, well, actually we're missing a trick, because it'd be cheaper to pay salaries and claim the employment allowance back than have dividends which isn't subject to NI.
Yeah. It's complicated.
So have I lost you already?
No, not at all, not at all. But this is why, as your circumstances change, right, you've got to keep not only fresh with what's going on with legislation, but clearly making sure that, on your life cycle of being a business person or a professional, or, depending which field you're in, what served you well at the beginning may not be what you need today, and especially if you're in growth mode. So going from startup entrepreneur to, say, multiple business owner. So we're in a position where we've got a couple of companies, we've got a partnership. We're in our business together, my husband and I, which I can now say. Chris will kill me for that. But
that's her husband, not me.
The other Chris. I'm not married to this one. I'm not a bigamist. But yeah, so through that life cycle, we've also changed from, startup to evolve into different entities, etc. So when you get to be having multiple businesses, what are some of the tax tricks, all legal, let's be 100% clear on this, to optimize a position between different businesses that you've got as you've grown, maybe?
So generally, I find that if you are in expansion mode, it's very unusual that the business you started with is the one that would suit you going forwards. So that's why it's often beneficial to have different types of businesses for different reasons. So we had a client that came to us and they had a limited company. They started off and the building company did really well. And there was a husband and wife, two husbands and wives, and the kids all in there. And they were doing so well, they all had expensive cars. And the cars were costing an absolute fortune, about £250,000 in taxable benefits in kind. As I explained, if we set up a limited liability partnership with a slightly different structure, there's no taxable benefit in kind on the cars in a limited liability partnership. So then what happened is they had a limited liability partnership and a limited company, and the items that would have attracted taxable benefits in kind in the form of P11Ds and Class 1A national insurance aren't in the company, they're in the LLP. And as long as the LLP is structured right, there's a couple of tax cases where the accountant did it wrong, but as long as you structure it right, then you have completely avoid the P11D and the employer's NI, Class 1A NI, on those benefits in kind. So you just want to make sure that your structure's different to take advantage of it. Now conversely, if I had a partnership and let's say they were doing really well and they started off making, let's say, 100 grand profit, and then 300 grand, then 500 grand, and let's say 5 million. Well, if the 5 million was in a partnership, you'd be taxed on the partners on the full 5 million. And you say, well, we don't need 5 million to live on. Let's say we need 500,000. So therefore, it might be better to have those profits in a limited company, because the company on that stage would pay a maximum 25% corporation tax profits, whereas an individual would pay 45% tax on it. And you could park it in the limited company and then take it out at a later stage, because some of these property businesses, they're sort of a bit like that. And so you might want to say, well, when I'm up there, I'm paying 45% on everything, and I've had a really bad year here, and I've got no income. So you can taper it with your company and your partnership as to how you extract the profits. So, and also sort of property ownership, in that it's not always beneficial to have properties in a limited company. Now, in the budget, the 30th of October, they increased capital gains tax to 24% on everything. Prior to that, it was 24% on residential property, 20% on commercial property, 20% on shares and other items. Now it's 24% on the whole lot, whether your property is commercial property or residential property. And some people bought property in pensions, and that's a bit of a nightmare now for those people that did that, and extracting it is very difficult. I don't know if you want me to explain about pensions, but that's a nightmare that they changed in the budget as well. So there's lots of things on capital taxes that are significantly detrimental since the 30th of October.
So if you're enjoying this episode, please hit that subscribe button so that you never miss insights from leaders like Chris. We've got more bold conversations coming your way. So subscribe now. Let's get back to the show. And if you're... Thank you for this, Chris, because it is a bit of a minefield for people, but I wanted us to be able to touch on different kind of interested parties, shall we say, just to kind of at least make people aware of some of the basic things that they may not be aware of in terms of, being able to structure things in the right way. So if you're a business owner, obviously whether that's multiple businesses or you might just have one business, obviously one of the benefits of that is you're able to put expenses through that business that are genuine expenses, of course, but that may include certain things that maybe people don't realise they could put through as a business expense, which then reduces the profit in the business, which then reduces the corporation tax. Yes? In simple terms. Am I correct? Yes. I'm looking at him going, am I correct? No, right. Where's I going with the question? If a business is loss-making, you can carry forward those losses, can't you, into future financial years, so that...
What type of business?
So say it's a limited company,
Okay.
and that business has been in startup mode, it's been in growth mode, it's maybe not profitable for the first 2-3 years, say, which isn't unusual when you're starting a business. It can often be loss making in the early years. So if you've got negative profits, you're not paying tax. Can you just explain how that works when, over a period of time, you carry forward those losses for a period for X number of years, and then you start to pay tax when you get into a profitable position? But do you want to just explain that? Because again, it's not just the 1 year, is it, that's looked at in isolation?
So if you want to get any more details about this, we've done a great article called The Guest House.
Oh, okay, great.
And it's on our website, and I call it a great article because we actually did save someone, I think, £250,000. I'll tell you why.
£250,000.
So they came, wife said, I've got some friends round, let's have some drinks Sunday afternoon. So we were chatting to the husband. I said, how's things? He said, oh, great. I said, I was on PAYE for ages. I'm just retiring now. My wife doesn't work, but we're going to sell our house and we're going to buy a guest house. I said, oh, that's good. How are you doing that? I said, oh, we found this accountant locally. They live some way away. And he's really good. And he just said, well, it's simple. You just buy it in a limited company. It'd be brilliant. So I said, okay. There are other ways of doing this. And he said, what do you mean? And I said, well, I think there's a better way. And he said, what do you mean there's a better way? So I said, I thought you said earlier that you're going to make a loss. He said, yeah, we're going to buy the guest house and it will need a lot of work. We've got to get it up and running. We want to create some goodwill. And I think we'll probably make a loss in the first 2 years. Now, that loss in the limited company, you can only carry forward to offset against the profits of the company in future years. And if you didn't make the profits, there's nothing you can do with it. You just carry the loss forwards.
Yeah.
Now, if they buy it, my suggestion is you buy the guest house in their own name and run it as a partnership. They said, well, what's the advantages of that? Well, they were living in the guest house because they sold their house. So that was their principal private residence. So that means that when they sold that property, part of it would be free from capital gains tax. Whereas if the guest house is owned by a limited company, it's not their principal private residence because it's owned by the company,
Yes.
not by them.
Okay.
So they lose that exemption. The other thing is there's a letting exemption of up to £40,000 on capital gains tax. And because they changed the rules, they made them much harder. But now, if you live in the property, you can claim that. Well, they do live in the property because they live in one of the bedrooms and they rent out another 12, I think. So then they can claim that exemption when they sell it as well. And then the other thing is because he's going to make a loss, I would allocate. So if we made it a partnership, husband and wife, allocate the loss to the husband. He can carry the loss back against his PAYE income for the previous years and get a PAYE refund, and he can do that for the first 3 years. So he can carry it back up to 4 years and get a PAYE refund, none of which you could do if it's a limited company.
Right.
So I did the numbers for him and I said, I think we can save at least £250,000 on that because a lot of that saving is on the capital gain on exit, which they would never realise. So they said, well, it's all a bit complicated. Can you do me an email so I can give it to my accountant? So I said, yeah, tell me what happened. So they rang me up a couple of weeks later, said, we had the meeting with the accountant, we showed him the email, and he said, yeah, you can do it that way if you want. But he never suggested that in the first place.
Wow.
He just said a limited company, and they never knew that there's another way of doing it. And a lot of it is that I think it's like Donald Rumsfeld. He says there's known knowns and the unknown knowns, but you don't know the unknown knowns because no one told you.
Yeah.
So no one told them that there was a different way of doing it. And that's a lot of the problem with tax, because if you don't know, you're going down a route and you think no one told you there was also that route.
Yeah.
And that's the issue. And then with that, they could physically get a PAYE refund each year to cover them with the loss, to help the cash flow. And then on exit, they've got all that capital gains tax they're saving that they'd lose otherwise if it was a limited company. So a lot of it is just a case of setting up the structure right in the first place.
Yeah, but what I think you do exceptionally well, and again, not wishing to just kind of, sing your praises, but I genuinely mean this, is I think you take the time to get to know the individuals, to understand their broader life situation, not just the one business or the one aspect, and that then allows you to kind of look in your toolkit and go, right, okay, we can use that spanner, we can use that screwdriver, we can use that, and actually putting it together in a way that you've just described there, because that not all accountants will do that.
I think it's not just that, is that not all accountants know how to do it. So we had a client that rang us up and they said, can you help us with tax? And I said, sure, what's the problem? They said, well, we need a limited liability partnership. And we rang our accountant up and said, can you help us with this? And they said, we'll Google limited liability partnerships. And they said, well, we then realised it's not the accountant for us.
Yeah.
They said, we went on Google and you were in on the first page. And a lot of it is, if you don't know all the tools in your toolbox, if your toolbox is that big, you're never going to know the answers. That's the trouble.
Yeah. And it can be complicated, but the other thing that I think you know is important is to not be frightened to say, I don't understand, can you explain it again, you know, in layman's terms, in a way that, and I think sometimes people feel embarrassed, you know, that they feel a bit stupid that they should know this stuff. Well, why should you know it if you've never had to deal with it? And that's why you need to work with, you know, this is true in every aspect of business and life. You know, you work with people that are experts in their fields, that are better at you at these kind of things. But I think the advice I would also say is, don't be afraid to ask, or say, can you explain that to me again and again and again if needed? Can you put it, you know, and you're great at being able to simplify the complexity, because it is complex, right?
Yeah, I remember talking to a client and I said, they had a problem. I said, didn't you ask your accountant? They said, we did, but all that happens is he just sprouted section numbers and I didn't even understand what he's talking about.
Brain's about to explode. Absolutely.
And I always think it's a bit like a foreign language. I mean, you can't speak to them in German, you don't understand it. You've got to sort of gently just explain it at their level. You speak to HMRC at a different level. Well, if your client doesn't understand the issue, then why would they use you?
Yeah, absolutely. No, that's great. So just shifting on a little bit, Chris, because I want to try and give as maximum value as we can, and also make sure that people are able to kind of connect with you if they need help from you and your colleagues in Wilkins, Southworth. Okay. So property investing has changed a lot over the years.
Yeah.
So we have properties in R&O, we have properties in the limited company. We started growing that business. And then to your point, as you were talking earlier, I was thinking, when you said, the business you start isn't the one that you actually end up focusing on. And we've definitely shifted around in terms of kind of where the opportunities are and being able to pivot and grow, etc. So property is not easy, I will say. It's great to have assets and you can build an incredible business, but it's not as straightforward as sometimes people think. And it feels to me that it's getting harder, that, you know, where there were opportunities before, gradually those are kind of being closed down by government policy, etc. What are you seeing that's going on in the world of property, you know, buy-to-let, serviced accommodation? I don't want to go into everything commercial, but those are probably the big things, aren't they, where everyone was probably focusing on buy-to-let, let's go for buy-to-let, and then it was like, oh no, hang on a minute, SA is the thing to do, serviced accommodation, short-term, like, oh, hang on a minute, now there's complexity around that. So just a few tips on property, if people are wanting to get into it, some things to consider.
I think sort of the main issues with property from a tax point of view was predominantly brought in by George Osborne when he announced in 2016 Section 24, which is Section 24 is when, let me give you an example. Let's just say in those days you pay high rate tax if you were earning above £150,000. So let's say an example. Let's say in those days, 2016, I earned £150,000 on PAYE. I have one property I rent out. I've got £10,000 rental income, and let's just say my only expense is £10,000 mortgage interest.
Yep.
So that means I make no profit on that property. So in 2016, I paid no tax on that property because rental income's 10,000, mortgage interest is 10,000. When George Osborne's Clause 24 was brought in, it came in over 4 years. But then what it had the effect of doing is the £10,000 rental income was taxed at 45% on me, and the 10,000 mortgage interest wasn't the expense of the property, it was a tax reducer, and only got tax relief at 20% on the 10,000. So that means I paid tax of £2,500, i.e. 45% less 20%, 25% of 10,000, on a property that didn't make a profit. Now, I had got, at that stage, I had some clients that had 65 properties, and this was really bad news. So then what people wanted to do is they wanted to incorporate their properties at that stage. And they would have used something called Section 162 incorporation relief, where if you've got a business and a business isn't classified in the Taxes Acts, a trade is, but a business isn't. So going back to this person owned one property, that's not a business. So that wouldn't be subject, you wouldn't be able to get Section 162. My client's got 64 properties, that would have been, and then what you do is you transfer those 64 properties into a limited company that they own, and in return they get shares, and it doesn't trigger a capital gain. And the case that everyone refers to on that is Elizabeth Wine Ramsey, and that was decided at the upper tier tribunal by a judge called Judge Berner. She lost it at the first tier tribunal, won at the upper tier tribunal, and that's because it was a business. Now, what a lot of people then do is that they've put that into limited companies. The problem is that some very big firms, and two in particular come to mind, tried to use schemes to help people do that didn't work. HMRC have then brought in spotlights. Spotlight, if you just think of a torch shining on something, spotlight is HMRC saying, we don't like this, and spotlight number such and such highlights why we don't like it. And those two schemes meant that a lot of people have gone into tax schemes that just didn't work. HMRC are now opening inquiries, and we've got a number of those at the moment that we're dealing with to try and get these people out of the problem that these schemes put them into.
Right.
And those two firms are now closed down.
Wow.
So the problem, I feel sorry for those people because they would never, in my opinion, those schemes would never have worked. And a couple of my clients, we had meetings with the barristers that were proposing the schemes, and I had Zoom calls with my client and me, and I explained to them why it didn't work. They asserted that it did. My advice to the client was don't do it. They didn't do it, and now they're being closed down.
Wow. Yeah, it's constantly moving, isn't it? It's constantly moving. And serviced accommodation, Chris, short-term lets, holiday lets, however you want to term it. We have some, and it can be much higher cash flowing than a buy-to-let, but more complex because operationally, it's like a little hotel really. A mini hotel, you've got guest changeover, you've got cleaning to deal with, so operation, it's a pain in the ass. Plus, you then also have to pay the council tax, which you don't have to pay on a buy-to-let. But nonetheless, there was a big push, seemed to be a big push on serviced accommodation as being almost, that'll save you from the evils of buy-to-let, and everything's changed there. What are you seeing in serviced accommodation at the moment, Chris?
Well, the rules have changed again on the 6th of April. They used to be a lot more generous. They used to be treated as trades for pension purposes. You used to get the old entrepreneurs relief, and now the reincarnated version is business property relief. They're no longer eligible for that. Interest was tax deductible as an expense, which isn't anymore. They're still subject to VAT if you fall foul of the VAT rules. But it's like anything, if you can make them work, they're still beneficial. I've got some clients that've got furnished holiday lets on the south coast and Devon and Cornwall, and the thing that's making it difficult for them is double rates. So the council are charging double the rates, and they're saying it's just so expensive that they're finding it very hard to make ends meet.
Yeah, because and certainly in Wales, where we live down in South Wales, or split our time between Wales and London, but they're talking about triple council tax. Right. So if you're paying, I don't know, let's say £4,000 on your council tax, you've got an extra £8,000 of costs even before you start. Yeah. Right. I mean, it feels, again, I'm not wishing to sort of bash the government because I don't want to get political, but it does feel that people that are trying their hardest to do the right thing, build generational wealth. Often this is around creating a legacy, passing on to their kids or whatever. You know, not everyone is trying to build a big business empire. They're just trying to sort of do their best, work hard and do the right thing. It just feels that it's constantly hard work to do that.
Yes.
So it is, like you say, but we love property. We love the assets, right? We like the equity growth as well. Yeah. But if you're in it for cash flow, it's quite hard, isn't it?
Yes, I've got some clients that basically they're in it for the capital gain.
Yeah.
So even if it just breaks even, if in London they used to say that property prices double every 10 years. So even if you just break even, in theory, your assets doubled in price and your mortgage has stayed the same or gone down.
Exactly. And certainly, you know, we've benefited from capital growth like that, definitely. So I want to talk about now, Chris, couples who aren't married. So there's a number of things, and I don't wish to make this about me or about Chris and I, but if you're in a situation where you've been together as a couple for a long time, you've got your life together, you've built all your wealth together, but you're not married, what are some of the considerations for couples that are not married? And then they may get married, and then again there might be some other things they need to be aware of.
Okay, so I guess the two main things I'd be considering are capital taxes. So in the old days, if you were married, it made a difference to income tax. But now we're into ITSA, income tax self-assessment, where the fact that you are not married or married doesn't really make any difference because you're taxed as individual people.
Okay,
from an income tax point of view. So your tax liability doesn't change irregardless of how much Chris does or doesn't earn. But capital gains and inheritance tax do. So if you were both single, then you could each own a property and you could live in a property each, and that will be free from capital gains tax because it's your own properties and you meet up in the evenings or something. If you're married, you only get one principal private residence between you. Therefore, if, for sake of argument, Chris moved in with you, then his property will be subject to capital gains tax because you are married, so you only have one property, not two anymore.
So it's a disadvantage in that example.
From capital gains
from
tax.
A capital gains tax perspective.
So it's an advantage not being married from a capital gains tax point of view. But the other capital tax is very important as you get older, is inheritance tax. So if you died being single, and let's say one of you died owning a property, let's say £1 million, then the first £325,000 of their estate will be exempt from inheritance tax. And if they didn't have any kids, they couldn't claim a residence nil rate band because they couldn't leave the property to them. So that's £325,000. So that means that the balance of that estate, £675,000, will be subject to inheritance tax of 40%. If they're married, they could leave their assets to their spouse, and there's no inheritance tax on a spousal transfer. Now, then what that means is that if there was a tragic early death, then the surviving spouse has 7 years to pass those assets to family members or charities or whatever they want to do with it. And as long as they live 7 years, then they're not subject to inheritance tax upon their death. So they could decide to pass their assets around to other people, reduce their estate, which means less is subject to inheritance tax.
So this is very real. It's very real. So Chris and I have recently got married, and this Chris was delighted. He said, that's very, very good inheritance tax planning. Well done after 20 years.
And you do need new wills.
And this is the other point. Now, check this out. So you informed us of this. Again, massive value add for us because we had no clue at all. So if you've not been married, and then you get married, so you might have all your affairs in order, your power of attorneys, your wills done, and think, tickety-boo, I'm good. And actually, an astonishing proportion of people don't even have a will written, do they?
No.
I don't know, do you know what the stats are on that? Chris, I know it's not tax,
no, but I mean,
it's high though, I think.
The thing that worries me is a lot of people come to me and I say, have you got a will? I said, no, but it's nearly there. I said, well, sign it. So what do you mean? I said, well, sign it now, and then at least you got something when you die. You don't want to die intestate.
No.
And then once you got something signed, then you've got time to change it. But if you've got nothing signed, you've got nothing in writing, and then you're going to die intestate, and it might not go to where you want it to go.
And it's a bloody mess for whoever's left behind to deal with it, right, as well. So get your will, get your power of attorneys done is one message. But then secondly, in our situation, we then got married. We had our wills done. We had our power of attorney. I'm not changing my name. I'm keeping Jeannette Linfoot as the footster. So I've not even changed my name. And then you said to us,
you need to change your wills because upon getting married, it validates the previous will, and you need to take advantage of your spousal reliefs between the two of you. So then you can prioritise who you leave it to, etc.
Yeah.
So it's very important that you do update your wills.
Yeah, which we never even knew. And I was going, I don't understand. I'm not even changing my name. Why do I need to change my will? I'm still me.
But your will wouldn't have said, I leave X to my spouse, because you weren't married before.
No.
But now you are, so you can.
It says, it would have said partner. It needs to be spouse. One word. It's important. But yeah, honestly, all of this stuff, it can be really daunting. It can be a minefield. But if you've got the right advice and you've got the right people on your team, and you take the action, you don't just hear the advice and then do nothing with it, because then what is it Rob Moore says? To know and not to do is to not know. Get your teeth around that.
I say that the people who fail to plan to fail.
Oh yes, another good one.
You've got a plan.
Amazing. What else have we got? Let me see here. Nearing retirement. Anything specific on someone that's maybe they might not have even had a business. They might have been had a career and worked for another organisation. Any sort of final points on someone heading towards retirement that they might need to think about from a tax point of view?
I had a client that came to see me on the 31st of October last year, which is the day after budget day.
Uh-huh.
And he said that he'd been saving into his pension all his life. And although it might sound a lot, he's got £1 million in a pension fund. And the advice was that £1 million would be left to his kids because his wife had enough money. So that £1 million would not be subject to inheritance tax. Now it is subject to inheritance tax. So that was changed on the budget on the 30th of October. So the problem then is if that guy died after the rules kick in 2017, then what it means is that he's then going to be subject to 40% tax on his £1 million because he's left it to the kids. So that leaves it with £600,000. They're going to pay income tax on drawdown of the pension, and they're high rate taxpayers, that's 45%. So that means that £1 million is effectively taxed at over 60%.
Wow.
And he's only had tax relief at 40 or 45% and putting it in. So all his tax planning from that point of view has gone out the window. Then the other thing is, I don't know the exact figures, but let's assume his limited company is worth £6 million trading business. The plan was also to leave that to his kids, and that would be free from inheritance tax because of business property relief. Now is only the first £1 million that's free. So suddenly that's subject to tax. So these inheritance tax changes have a massive effect, and you've got to plan your affairs to make sure that they don't bite on death. So in that scenario, the advice is, although it's sort of contracyclical, is that you should be drawing down your pension. Now, Jeremy Hunt in the March 24 budget said there was no pensions cap where it was before, but the amount you can draw out tax-free from your pension is 25% of £1,073,100, which is about £268,000. You could take that tax-free.
At 55, is it?
Yeah.
At age 55.
Or above. So what he's going to do is take the tax-free lump sum, give it away, say to his boys, but that means he's got to live 7 years because it's a gift.
Yeah.
And then he's got to draw down the balance, just under £750,000, and he'll pay income tax on drawdown. And then he can give it away.
Yeah.
So it triggers a larger income tax bill that he would never have considered before.
No.
So that's more. And then with his trading company, we've got to think of a way of spreading that around the family to avoid inheritance tax on anything over a value of £1 million.
Yeah, so all of this stuff, and I guess, sometimes a traditional way of thinking, certainly if you come from a background like mine, where I just grew up in a normal working class family, some of the things, well, don't get in debt, to job, work hard, maybe job for life, play it safe, risk averse, almost money's a little bit of it's seen in some negative ways, plan for your retirement, put it into your pension, that's safe. kind of changes the perception,
this
doesn't it?
client's been doing that for about 45 years, putting it into a pension.
Yeah.
So it can build up, and if it builds up to a lump sum, so then you've always worked on the assumption that that money would be free from inheritance tax and certainly not subject to income tax. And now, if I died before 75, then it's not subject to income tax on drawdown. Above that, it is. But suddenly, there's all these extra taxes that weren't going to be there before.
Yeah. Yeah, so it kind of takes us full circle from where we started this conversation, Chris, in that, there's hefty old tax bills that are hitting people in lots of ways that weren't before, which is leading sometimes for people kind of saying, I've had enough of this, I'm off to Portugal or I'm off to wherever. Yeah. But it's more complex and more intricate and interwoven, I think, than probably ever before between business, salaries.
Yeah. So if I give you an idea of it, this is a real case scenario. We've got a client that bought a property in 1995, a rental property, rented it out, and they bought it for £150,000. And 95, so in 30 years, is now worth £1,750,000. Mm-hmm. So the gross capital gain is 1.6 million. That's 1.75 million today's value, less £150,000 cost. If he gave that to his children, you create what's called a dry tax charge, because you pay capital gains tax at market value on that gift to a connected party. So whatever you sell it for, it's the same as if you give it away to a family member. So it's deemed to be at market value. So then, therefore, the gain is 1.6 million at 24%. So that's just under £400,000 to give it away. So when you do the numbers, you say to the client, that'll be £400,000. What you don't want them to say is, don't worry, they can sort it out when I die. Because £400,000 is a lot of money for capital gains tax. So you've got to give it to them and then live 7 years to make sure there's no tax charge on for inheritance tax as well as paying the capital gains tax. If they say, don't worry, leave it to the kids, then it's taxed at 40%. Let's assume that 325,000 inheritance tax exemption has been used up. Then it's 40% on 1.75 million, which is the gross sales price, the market value. Yep. And for inheritance tax, it's 40% on the value at death. 40% of that is £700,000 for inheritance tax. So I know which one I'd rather pay. But the point is, they'll say, look, I don't want to get involved in that. They can sort it out when I die. And the trouble is, inheritance tax is a lot more expensive. Yeah. Because you don't get any relief for the purchase price of it. And it's at 40%, not 24%. So then what happens is that if you don't plan for that, I sell it, pay the tax, which is a problem in itself, and then give it away and then live 7 years, you've got to plan a long time ahead for all this stuff.
Yeah, absolutely. Wow, I mean, this is mind-blowing for a lot of people listening to this, but I think, breaking it down into these different kind of categories of people is hugely helpful, and it is complex. So, Chris, where can people find you if they want to kind of connect with you, maybe, ask you to help them with their tax, obviously yourself personally, but the business, the company that you have?
Yeah, so we're based in Barnes. We've been here over 30 years, southwest London. We do everything we end up getting sort of some of the more complicated stuff. So most of the people here are qualified or in training contracts. We do overseas tax, UK tax. We do limited liability partnerships, which might not sound complicated, but a client approached us and said that our accountant didn't even know what a limited liability partnership was. And it's just a case of you need to give clients the benefit of being able to look at the whole panoply, and then say, well, I think that one's better for you than that. And it's a bit like the guest house example. The accountant just hadn't even thought about it. It's just like, well, every answer is a limited company. Well, it's not. Every answer isn't a limited company, because you just got to think about it a bit more.
Yeah, and the website is
www.wilkinssouthworth.co.uk.
Great.
And we've got loads of videos, we've got articles, we've got YouTube, we've got we're in Instagram, TikTok. You'll be able to find us on there.
And so there's a load of free content there for you to get yourself up to speed, for sure. But then, of course, it's great to have the right advice that's tailored to your situation. You can bounce it back and forth. So, Chris, it's been amazing. Thank you so much for all of your amazing insight. And I've got one last question for you, which I'm going to throw on you. You've given loads of great advice now, right? Gazillions of advice in this conversation. Can you think of some advice that you've received, doesn't have to be tax related, just in general, that's been a really good piece of advice that's helped you in your kind of career, your business life, your personal life?
I mean, me personally, in my business, I think is sort of having confidence in your own abilities, a lot of it. And what happens is that you think you always, when you start off in business, you always feel a bit timid that you don't know what you're doing because you're sort of dipping your toe into the water. But the point is, when you dip it in, you're going to learn quick. And with the right advice, you will sort of the world's your oyster, really. But I mean, there are a lot of obstacles. You just need good advisors to help you get through those obstacles.
Yeah, amazing. Thank you very much. Paying it forward as always, Chris. Thank you.
Pleasure.
And there you have it. Chris Wilkins, FCCA, a trusted advisor helping businesses not just survive but thrive by mastering the art and science of tax and financial planning. From guiding startups to global investors, Chris's work, it shows that building resilience and planning ahead are the keys to long-term success. Now, if today's episode sparked ideas or gave you new clarity, please subscribe, leave a review and share with someone ready to take their business and finances to the next level. And for more inspiration and resources, check out www.brave-bold-brilliant.com. And as always, keep being brave, bold, and brilliant. Until next time.